Hi everyone. Direct capitalization can be used as a shortcut to determine the market value of an investment asset, which means you skip the multi-year cash flow projection. Cap rates are, in effect, just a way of normalizing the quoting of pricing of properties in the real estate investment market. As the inverse of the price paid per dollar of current net income, cap rates control for the scale of the property and express the price in terms of a component of the investment return, the initial income yield. Since the cap rate is the net income divided by the price, you can apply the cap rate to derive the money-valued price of a property by inverting the cap rate construction. Divide the property net income by the cap rate to obtain an estimate of the property value. This shortcut is most appropriate to use for buildings with short-term leases in less cyclical markets, such as apartment buildings. This is because cycles in the rental market and existing long-term leases in a property that may have been signed when market rents were different can create unusual or irregular expected future cash flow profiles in the property. In such circumstances, it is dangerous to skip the multi-year cash flow forecast and base the price estimate only on the current income. The full multi-year DCF procedure described in the preceding units are necessary to avoid a pricing mistake. However, in many cases, direct capitalization can be a useful shortcut. Let's look at an example. Suppose an investor wants to determine the market value of a 250-unit apartment complex. The expected average rent is $15,000 per unit per year, and the vacancy rate is expected to be 5%. Annual operating expenses are expected to amount to $6,000 per unit, and empirical evidence shows that the cap rate in the current property market is 8.8%. In order to use the direct capitalization shortcut, you have to calculate the net operating income. Start by calculating the potential gross income, which is $15,000 per unit, times 250 units. This gives you a PGI of $3,750,000. To calculate the vacancy allowance, multiply the PGI of $3,750,000 by the vacancy rate of 5% to get $187,500. Lastly, calculate the operating expenses by multiplying $6,000 by 250 units, which gives you $1.5 million. Net operating income is then calculated by deducting the vacancy allowance and the operating expenses from the PGI, giving you an amount of $2,062,500. This is the same terminology and procedure that we described in a previous unit for constructing the cash flow pro forma. But now we're not trying to forecast future years. We're just computing the net income for 1 year, the current or next upcoming year. Now that you have the net operating income, divide it by the cap rate of 8.8% to get an estimate of the property value. In this case, $23,437,500. The cap rate may be applied either backward-looking, based on the current or past year's net income, or forward-looking, based on the next year's net income. Forward-looking cap rates are most common in the investment industry, though both ways may be used. It is important to note that, although shortcuts are easy to use, they can be inaccurate if the property does not display the cash flow growth and risk pattern typical of other properties from which the applied cap rate was obtained. As noted earlier, if the property you're trying to evaluate has an abnormal pattern of occupancy or lease expirations, or if the rental market is strongly cyclical and you're at an extreme point in the cycle, you may get a misleading estimate of the value of the property if you just apply the direct capitalization method without doing the full multi-year DCF evaluation. Also, market-based ratio valuations, like direct capitalization, simply reflect the current market. If the market is experiencing a bubble, the direct capitalization shortcut will simply reflect that bubble, whereas other methods can be more robust and give you greater ability to take a pricing bubble into consideration. For example, we saw earlier how estimation of the opportunity cost of capital in the context of the multi-year DCF analysis can help to place property valuation into a cyclical context. In this video, you learned that there is a shortcut which is often useful for estimating the market value of an investment property. Simply divide the property's current net income by the cap rate prevailing in the local market. However, it is important to understand that this method has some limitations, and that it might be wise to use the longer, more complete discounted cash flow procedure in many instances. However, direct capitalization can provide a good indication of typical current market value, and in this way can be combined with multi-year DCF to help hone DCF analysis and gain investment insight from it. Reflecting on what you have learned in this video, what would you expect the impact of a sudden surge in general inflation to be on prevailing cap rate?